What up, guys? We're back at it with another YouTube video. I hope you're good and I hope you're great. In today's video, we're going to speak about different types of ways to approach the market, different trading strategies. So if you're new to the channel, please subscribe and make sure that you hit the like button at the end of the video if you enjoyed the video. So let's get right back. Let's get into it, guys. So today we're going to speak about retail trading and smart money concept, which is institutional trading and the indicators. Alright. So firstly, going to start off with retail trading. What you'd like to do with the retail, you'd like to start off on the higher time frame. Okay, I'm going to explain them in detail, not going deep into explaining how to strategize your entries and stuff like that, but I'm going to show you and you decide which one is for you, what type of a trader are you. Okay, so what you'd like to do is to first start on a higher time frame when analyzing with the retail approach, of course, as well as smart money concept. So what we have here is in a 100 H4 time frame. Mostly, if you'd like to, you can also start on a daily, but 4 hour time frame is also fine. But if you want to get a whole bigger picture, then you should jump right into a higher time frame, go deeper. So what we have here is, as you can see, the market is currently on a downtrend. The market is currently on a downtrend. So we're going to draw a trend line right here, as you can see. So I'm going to, I'm not explaining a beginner's, I'm not explaining a beginner's strategy. I'm going to go into more advanced, I'm going to go deeper into an advanced retail approach. So as you can see right here, we have a downtrend on daily time frame. So we're going to jump right down to H4, right? And as we jump down to H4, we also have patterns within patterns. Okay, you're going to have patterns within patterns. As you can see right here, we had a trend line right here. We had a channel right here, as you can see. In this case, say the market was right at the top right here. Say the market was right at the top right here. What you do, let me just draw it for you, and so you can see where I'm actually pointing out. Let's take an ellipse. Say the market was here. Say the market was here. Say the market was there, and you see an opportunity to enter a trade, and you have this channel right here. A good way to approach this trade would have been finding a channel within a channel on a lower time frame. Okay, on a lower time frame. So I'm not going to jump into H1 because I'm going to mess things up if I do, but on a lower time frame, on H1 time frame, I'm pretty sure that we have something like this. Okay, we have something like this, which is an extra confirmation that we can enter SF, right? But before jumping into SF, you should at least wait for the market to break out, break out below this trend line right here, and you will have entered a sell. Okay, you would have entered a sell, but not right straight up into it like this, because you need extra confirmations. You get extra confirmations when you go down into lower time frames and stuff like that. You get more confirmations as you jump down into lower time frames. As we all know, when the market breaks down the trend line, you enter a trade. It depends on how the market is moving. Sometimes you wait for a confirmation, what's the correction? Impulse correction. If you're a retail trader, then it is essential for you to follow these patterns before entering a trade. Okay, as you can see, let's say this is an impulse movement going downward. It's an impulse mover and a correction. Impulse correction. That's how the market moves. That's how retail traders see the market move. Okay, so as you can see, for instance, for example, here we have an impulse. Here we have an impulse, and we have a little bit of a correction right here, which is going to be clear on lower time frames. As you can see, impulse, correction, impulse. Okay, impulse. The market won't move perfectly, of course. It won't move in it's going to be a little bit choppy, but if you know your patterns, then it's going to be easy, right? So when it comes to retail, this is how like the market moves. You should learn your patterns. You should know your patterns. You should know the patterns within patterns. Okay, that's the things that you need to learn. But you should also be able to see patterns on higher time frames. Like this one right here. This is a correction. This is a correction. Right? This is a correction. And it's going to be clearer on lower time frame. Let's say for instance 30 minutes time frame, as you can see. Impulse, correction, impulse, impulse, correction, and then impulse, as you can see right there. Okay, yeah. Let me remove that. As you can see, after this impulse movement, we had our correction again. Okay, we had our correction and then another impulse. What's happening right now? As you can see, impulse, correction, impulse, and we had another correction, and then we had another impulse, correction, impulse, just like that, going forward. You feel me? Going forward. But according to me, retail trading, it's a little bit complicated, but if you are an experienced trader, then it's going to be much easier for you because you have experience and you've learned what works and what doesn't. Okay, so this is like according to how I see the market is on 1 hour time frame. I think the market has to reach to this level right here, which we call the 90% rule. Okay, if you have a channel or if you have an uptrend and you have your trend lines in place and the market breaks either if the market is on a downtrend and the market breaks out on an like going up, then you know that okay, it's going to have to reach to the 90%, which in this case this is the 90% rule. The market was on an uptrend and it broke out. The market still needs to reach this level right here. The market still needs to go down and reach this level right here. It may go up a little bit, maybe return from this level and come back, but it has to come back to this level, to this point right here. That's where the market is going. And since today it's Sunday, you're going to have, find a way where, even right here, we also have, something like this. We also have something like this. So when the market gives you something like this, then you know, okay, it will go down. Doesn't matter how it's going to go down, but it will go down and then come to this point before continuing its uptrend. And when it continues the uptrend, it's going to break out and then give you a correction. So look out for these patterns after giving you a correction in impulse. Right, it's going to give you a correction and then an impulse. So that's it for retail. Okay, since it's Sunday today, I cannot say this is how the market is going to move. This is not a signal or something like that. I'm just explaining how retail traders approach the market. Okay, so let's jump into a smart money concept now. Okay, let's jump into smart money concept. With smart money, you don't have to go on deeper into higher time frames, but if you want to, you can. If you're it depends on what kind of a trader. If you're a swing trader, then you can swing it on higher time frames like H4 and daily time frame. Okay, if you have patience and you can swing. But if you're a scalper, the time frames that you need to use is like H1 and 15 minutes time frame, 30 minutes time frame, 5 minutes time frame, even 1 minute time frame on smart money concept. But the levels that are stronger are the levels which are the higher time frames, the higher time frames, then okay. If you have a support level on H4 time frame, then it's going to be valid and it's going to hold for a long time. And you should be confident with that. But comparing it to a support level that's on 15-minute time frame or 5-minute time frame, then it might hold, but not for long. So I'm pretty sure most of y'all have heard a saying that the smart money concept, you trade with the banks, and the banks put their orders on certain levels, like right here. What I'm looking at right now, I already know that okay, the market was on the order block right here. This is what we call an order block. Okay, the market was on a downtrend, short-term downtrend. Since we are on 1 hour time frame, you don't have to jump higher into higher time frames. This is all you need to achieve the current time frame that I'm on H1 time frame. Then I can see, as you can see, the market was on a downtrend. The market is on a short-term downtrend. As you can see, we have a higher high, higher low, higher high, higher lows. In the market, right shape broke out. Okay, the market broke structure. The market broke structure. Change of character, break of structure, whatever you want to call it. This is what happened. Okay, let me just remove this right here. This is what happened. As soon as the market breaks structure, as soon as the market breaks the previous high or the previous low, depending on whether it's on an uptrend or a downtrend, then you find the last candlestick, the last, if the market was on a downtrend and it breaks structure or it changes character, you find the last bearish candlestick and you draw a support zone or support level from it. Okay, you draw a support zone or support level from it like this. As you can see, the market broke structure. What I mean by the market broke structure, for example, if you're a retail trader, you might not understand what I'm speaking about or what I'm talking about. It's the same as a breakout. Say, for instance, this is a retail approach. Okay, you're a retail trader and you're approaching the market like this. What a retail trader would have done in this case would have, like, as you can see, it's a breakout. They would have waited for at least like a correction. Most of the experienced retail traders, they don't just jump into the market as soon as the market breaks up. Okay, you wait for a correction. After the market gives you a correction and then an impulse, that's when you can enter. All right, but as you can see, you can choose which strategy is better. As you can see, if you was a retail trader in this case, this is what would have happened. Okay, it's a breakout, and you would have thought, okay, the market broke out, let me enter a buy. After entering that buy, and then the market, what does let's say, for instance, you would have entered the buy right here. Okay, it's a breakout. You would have entered a buy at this level with the hopes that the market will go up. A stop loss high share, maybe enter high share, and then put a take profit of maybe this level here. And then you would have gotten stopped out. In this case, you would have gotten stopped out. So as an institutional trader, okay, the banks have their buy orders in this level. The banks have their buy orders in this level. This level right here, that's where the banks have their buy orders. They are the ones that move the market because the money that they invested into that order, it's huge. So the market has to move in that direction that the banks have put in their buy orders or sell orders. As you can see, the market tapped into this order block and it's going up right now. It's going up right now. Maybe the take profit will be at this level, Depends on your account, but it also depends on how the market moves. So your first take profit maybe should be like, your nearest resistant level. Okay, and then it will depend on how the market reacts when it reaches this level. If it breaks it, okay, if it breaks it again, for example, if it breaks this structure, you know, say this is how the market will go. Okay, say this is how the market will go. Say if this is how the market will go, break the structure, and then retest the last bearish candlestick. Doesn't matter where the candlestick is, excuse me, and then continue. This is a continuation pattern when it comes to smart money or institutional trading. Say the last bearish candlestick is right here. What you would have done is to enter more buys if you still holding the trade. You'll enter more buys in this case. And then there's also a confirmation entry when it comes to institutional trading. Confirm your interest before entering. As in this case, as you can see, this is where the market is. What you're going to do is to go on a lower time frame and find the same pattern like this, on the lower time frame. Okay, the same pattern like this on the lower time frame. You see this whole pattern right here. We're going to find the same pattern on the lower time frame to confirm the buy. In this case, let's go on the lower time frame and see what we can find. Let's go on, say 15 minutes. As you can see, we're on a 15 minutes chart time frame right now. Okay. What we're going to do is to wait for maybe the market to break this zone right here. Okay, break out right here, and then come back again to retest the last bearish candlestick and then continue its bullish trend. Okay, if you want to as well, you can also jump into 5 minutes time frame. So now that we are on 5 minutes time frame, you can see that the pattern that you saw on 1 hour time frame, you should find the same pattern on 5 minutes time frame. Okay, in this case, we're going to wait for the market. It might go down, but it has to break this structure and then come back to retest this order block. Okay, when it retests this order block, that's when you can enter your buys. And in this, if you find the trade like this, then your stop loss is much tighter. Okay, your stop loss is much tighter than it would have been on H1 time frame. Okay, still the same trade, is still the same, but your stop loss is now tighter because of the confirmation on 5 minutes time frame. And usually these type of entries are what sniper entries. These are the entries where straight to profit after entering a buy. You go straight into profit. Simple, plain. But most of the times when you try to find trades like this, then you might miss trades because the market sometimes might not, after breaking the structure, might not come back to retest the order block from lower time and then and just shoot up. Okay, so that's my point of view when it comes to smart money. I prefer smart money concept over retail trading. Okay, according to experience, because I've been a retail trader and I've been an institutional trader. Okay, so right now we're going to jump into indicators. Okay, we're done with institutional and SMC. Let's jump into indicators. The best indicator that I actually use currently, I've been trading for a long period of time, for like 3 years, guys, and I've seen results and I've seen my downfall. I've experienced a lot of emotions and stuff like that. So you are on the right hands, guys, if you want to learn how to trade and Also, don't let them fool you, or don't, come to a mentality, psychology. Your psychology is the one that's going to, break you through to being a successful trader. Your psychology is the one that's going to make you break through to being a successful trader, because sometimes you can have the knowledge and you can have the skill, but then lack uh, patience, or lack the necessary needed in psychology for you to like put on a trade, for entering a trade. But that's a conversation for another video. Like I said, my favorite indicator is RSI. I know most indicators are lagging and stuff like that, but with RSI, guys, trust me, you'll never go wrong. Okay, you'll never go wrong. I've moved to being a scalper because of the time that I spent on because I'm also not just a trader, but I also have businesses that I need to attend to. I get busy at some time. I get busy at some point, to to a point where like I do not have enough time to wait for the market to reach a certain level. For the market to give me a certain pattern for me to enter. I just couldn't wait anymore. So I went to scalping, and this is the strategy that works for me, and it works really well for me lately. I've been getting, you know, tremendous results. So if you can try it out, guys, give me feedback and tell me, okay, how does it do? How does it work for you? Is it working for you, or what type of a trader are you? But as you can see on my previous video, I did explain this strategy. So if you haven't seen that video, or you do not know, please jump back into my previous video, the one that I posted before this one. That's where you'll find everything. That's where you'll find me explaining this strategy, right, guys? But to just explain a little bit, as you can see, you know how RSI works, guys. The 30 level is the lower one, and the 70 level is the highest one, and the 50 is in the middle. Okay, so on the 1 minute time frame, what you need to do is to wait for the market to give you is to wait for the RSI to reach the 30 level if you want to buy. As you can see right here, we have an RSI. We have an RSI which is at, as you can see, it's right here. It's at 30. As soon as the market, as soon as the RSI is at 30, then okay, I'm going to look for a buy. But instead of just jumping straight into a buy, you need extra confirmation. You need more confirmation. And to be honest, with RSI and scalping, you do not necessarily need a laptop. All you need is a cell phone and RSI and a moving average. Okay, as you can see, the RSI has a moving average in it. This is the moving average that it has, which is the 14 SMA. Okay, simple moving average. Most of the times you won't put it like this on the mobile phone. You have to apply it on the chart. So in this case, the RSI is at 30. As you can see, the market shot up immediately after moving away from the 30 level. So if you need a more safer entry or a more safer trade, is to wait for the RSI to go above the yellow moving average. After going above the yellow moving average, then okay, let me enter a buy. You enter a buy and you take profit on your nearest resistance level on 1 minute time frame, because it's a scalping. You don't have to hold trades for a long period of time. You just have to hold it for a few minutes, then you're out. Okay, say maybe your first take profit would have been this point. Okay, as you can see, as soon as the market reached that point, it immediately went down a little bit before going up. Okay, in this case, after entering a buy, you put your stop loss below. Okay, and right now I believe when the market opens, it's going to go down, because as you can see, we had our high right here. The RSI was at the 70 level. As soon as the RSI was at the 70 level, the market went down. Okay, this is how I think the market will move as soon as the market opens. Okay, but this is a 1 minute time frame. Don't forget, this is a 1 minute time frame. The market will, like, say maybe you enter a trade here. Say you enter a trade here. your stop loss here. Okay, so you enter the trade right here. As soon as the RSI went below the moving average, your stop loss should be a little bit above, okay, or on your nearest resistance level. And then I think the market is still going to go down after the market opens because the RSI is still below the yellow moving average. Okay, it's still below the yellow moving average. As long as you put your stop loss intact, then you know you save. Plus the stop loss is going to be tied on 1 minute time frame as well. You should try this strategy out, guys, and I'm still going to explain it more. I'm still going to post videos about it. I'm still going to post a lot of videos, so please make sure that you are subscribed and turn on the notification bell so that you don't miss any upload that I post. And if you have any question, please hit me up or comment down below, and I'll get back to you guys. So I hope this video was useful and you took a lot of information from it. Peace, guys. I'm out.